Welcome to the Dividend Talk podcast, episode 59. Earnings season continued. Hey guys, welcome back to another episode of Dividend Talk. European DJI and I will discuss with you today the most important news of the week, some earnings from popular stocks like Royal Dutch Shell and Danone. We will answer some of your questions and we will provide you with our stock pick of the week. If you are new to this podcast, don't forget to like us on your favorite podcast player. That is how you never miss a show. But hey, let's get started. See you on the inside. Good evening, European DJI. How are you today?
I'm naked. All these earnings this week. It's so crazy. I mean, I don't know how you're doing it, but it's for me waking up early before I start to work, make sure that I've got an hour to go through the notes. Bloody annoyed when a company doesn't publish their earnings when they promise at 7, but at 5 past 7, because it puts delay on my schedule between 7 and 8. And then, when I get home and the kids head to bed, comes another hour or two, and these evenings to just skim through the earnings, because, wow, this is such an exciting earnings season. It's really, really great.
It's a hectic week, and to be honest, I'm following a lot from our TEIN network. So lots of guys, Dividend Wave, Tiago, yourself, like you're just posting like clockwork. I get up in the morning. You already now. I know I'm an hour behind, so you have an hour ahead of me. But I mean, you have all the information there. Dividend Wave has it there. Tiago has it there. Dividend Dane has it there. I'm like, keep it going, guys, because I just don't got the time to be looking through all these companies. But there's so many, and we could talk about maybe 20, 30 companies today. But we'll keep it to 4 or 5, and we'll keep the show as slow as short as possible. But hey, before we get into that, what about China this week? I mean, people have been talking to me about buying Baba. I just knew they were going to drop. I knew there was no point in buying them above 200. It's been a bit of a wild ride this week, hasn't it?
Yeah, it sounds like Alibaba on the 200 is the same as AT&T on the 30 1 year ago. Yeah, when the pandemic hit. I mean, what happened effectively again? We had last week this noise around Didi, I think, this Chinese company. Now it was Tencent, because you need to know they have kind of, I think it's like you can compare it to Spotify of China.
Yeah.
I believe that they have 700 million subscribers, of which 120 million active paid subscribers. But they have exclusive rights on 80% of the music in China. So this is really like a monopoly per song. I mean, this is just a monopoly, and the Chinese government has a little bit like, quick on this, where in the US or Europe, you would first have committees studying it for 4 years to become before they have a verdict. In China, it's just like, hey, the math says you're a monopolist. We don't like it. Cut the crap. You need to give up these exclusive deals. But this surprises investors, and we don't like surprises, right? And specifically not from regulatory bodies and politics. And that's why I think on Monday all these Chinese stocks were impacted, and Alibaba as well. And I know that Richard from our community bought some at 181. So at this moment, that looked like he bought the dip. We'll see how it goes. It's a little bit of unrest there. But honestly, I find these always good times to buy some stocks like this here.
I mean, there's lots of news coming about China clamping down in so many different industries. I mean, we know they don't like monopolies. Which country do the same? As you said, the same in Europe and America. It's just a little bit slower to crack down. It's going to create a lot of volatility, and if you're interested in the Chinese market, it's probably a good time to buy. I know I was joking. I'll buy Alibaba if they drop to 100. I won't. I'm staying out of the Chinese market. But for anyone else that is into that, it's probably a really, really good time to start building up your positions. But hey, I expect we're going to be talking about Chinese regulations and dips and all sorts over the next few weeks, because it just seems to be oncoming all the time.
Yeah. Yeah, and maybe because those are technology stocks, the second thing this week was, because we will not zoom in onto those. I think most people are aware of that, but oh my God, Microsoft, Apple, Facebook, it's just crazy. Google as well, even
Yeah,
Tesla.
I mean, I look at Apple, and I remember when they split and they dropped in price. I think they dropped nearly below 100, and I really I wish I bought some at the time. I'm glad I bought Microsoft when I did, but man, they're just not. Look, they're kind of doing what we expect. You expect these big numbers from them now. If they don't post 50% growth, you're kind of almost disappointed at this rate. So
Yeah.
it's incredible what these guys are doing.
So I would really also warn a little bit about it, because we know that the stimulus checks, what was it, 1.9 trillion of checks went to the people in America.
Yeah.
Maybe I'm thinking too logical, but if I would get a $1,000 check and I don't need it, and buy an iPhone for it instead of a Samsung or some, I would buy some more luxury goods, yeah, to pleasure myself a little bit with that. And I wouldn't be surprised that, if you then, and this is just my simple theory, not based on facts, just my gut feel. So Apple benefits as a receiver on more iPhone sales, these iPlugs for the years, all this stuff. And then companies know this, that consumers have this money, so they spend more money on advertising on Facebook and on Google. So I really see this kind of as a result of that. I hope I'm wrong, because that means that the sales are sustainable. Let's say like that. But also Microsoft, Satya Nadella, this is just the growth story of the decade. It's amazing.
So I think it's a good time then to move on from tech stocks to some of the stocks we're going to look at. I'm excited about the first one. We all know I love this company. I haven't seen the earnings report. I saw a slight snippet of the dividend increase, but I'm going to let you take it away for Royal Dutch Shell.
Yeah, well, Royal Dutch Shell, they just blew us away with their cash flow this quarter. And we know it, right? Because
Yeah.
it's related to the oil price and the gas price, and actually sometimes more the gas price than the oil price. So they blew it away. They had a 14 billion CFFO. So that's really related to their reserves, right, that they have. And this is just blown away. And what I love about it is not even talking about the dividend. In one quarter, they went from 71 billion and a little bit in net debt to 65 billion, and 65 billion was their target. I mean, this is just like 5.5 billion debt reduction in a single quarter, and this is what for me is prudent management. Focus on this part, clean up the balance sheet. So what they're hoping now and targeting for is an AA credit rating. And this would be good for a company like Shell, because then their debt becomes cheaper again, because the risk is reduced. So, all of this creates this kind of spin wheel effect. But they're also targeting buybacks of 2 billion in the second part of this year. This is 1.5% of their market cap at current prices. So shareholders, again, would see a share reduction of 1.5% if the price doesn't do anything after today. But yeah, the big news was dividend increase of 38%. So it will be 24 dollar cents in per quarter. That makes it 96 cents, I think, with the current currency. That gives you 81 euro cents on the per share going forward. So, it's a big 4% yield right now. I don't think it's too late to step into Shell. I still think it could go in the upcoming weeks to 19 euro or something like that. I think with this earnings report, I think we see now a little bit of a floor of what we can expect in the upcoming year, maybe 2-3 years, provided there doesn't come a big economic crisis. But I think we've seen a bit of a floor now. I mean, these results are exceptional. Not sure if we will see the next 2 quarters again. It really depends on the oil price. But I think with their debt reduced into the levels where they needed it for a healthy balance sheet and such, the dividend increased. I think we have seen a floor here now that is being set at these price levels.
Big Ben knocked it out of the park. I mean, a lot of people questioned when they cut the dividend, and I suppose we both kind of agreed we felt it was right at the time. They were
Yeah.
focusing on clearing up that balance sheet, and the main focus at that time was to reduce the debt, which they have smashed, while also now starting to increase the dividend. Is this the third increase in a row, third quarter in a row?
Yeah, something like that. Yeah.
It's increased, and then share buybacks on top. We spoke a couple weeks ago. We expected an increase, a substantial increase. I don't think we would have said
No.
30%. I would have expected a little bit more to go into share buybacks, but I mean, I'm happy. I'm happy I bought more a couple weeks ago, and I said, so it's really good. Like you, I can't see this lasting forever. So the next quarter can't be as, I don't think so. It won't be as good depending on oil prices. But it's just, I think Shell are an example of a well managed company. I think they've handled everything almost textbook throughout the crisis and after. So I'm really happy, and I mean, as long as Ben is in charge, I'm a happy shareholder.
Yeah, me too. They're doing the right things, and it was really painful, right? The dividends last year, I really felt it in my portfolio. But to your point, it was the right thing to do. And for instance, ExxonMobil didn't do it. We still see them struggling also with the dividend. I think it also doesn't give you space to breathe to make strategic decisions with such a high dividend. So and I feel they have this now. Yeah, so they can focus more on the transition that they also need to go through with the new energy formats and such.
Yeah.
While still having a healthy return for us. So let's see how it plays out over the next 10 years. But I treat it a little bit like as tobacco stock at the moment. Out of favor, oil, but so much cash coming in that, we benefit from this.
Nice. Okay, so I'm going to talk a little bit about Teradyne. I don't know if I don't think we've ever spoke about them on this before, but they are a company that, as the semiconductor industry needs more chips, these are the guys that provide like test equipment in order to verify these chips and so on. So the more chips that are produced, the better these guys do. So the downside to that is they only have 4 or 5 big customers. You have Intel, Samsung, and Taiwan Semiconductor. So they'd be the main customers. If they were to move to another company, like one of their competitors, it would be a massive blow. But it probably costs too much money to do that. So they're quite safe. They are a very low yielding company, which is untypical for what we look at. I think their yield is more, it's sub 1%, about 0.3, 0.2%. They focus a lot more on share buybacks, and we can see this. The share price has grown from $40 last year up to nearly $130 at the moment. So the growth has been incredible from that perspective, not so much from a dividend. Really, really strong numbers this quarter. So their sales have been up 29%, earnings has been up. But what I really like about these is, and we all know that I'm into automation engineering, they have recently started going into industrial automation, which is exactly what I'm familiar with. They bought 2 companies. They bought Universal Robots and they bought MIR, M-I-R. And they grew 57% in quarter 2, which is absolutely huge. Now, I use both Universal Robots, and I think that they're great. We also have this MIR technology, so that we use them as like automated vehicles is what we have pretty much. And I'm not overly impressed with them, I have to say. Right, I've seen better, but from a company that they're investing in R&D and that, so you could see them getting better over time. But I'm really, really impressed with that side of the business. In terms of the test revenue, that's increasing because we're starting to see, as I said earlier, we're starting to see demand for chips, demand for their test equipment. They have also storage test equipment that tests like your HDDs, your STDs. That's also driving up as laptop sales grow and all this kind of thing. So I think it's a really, really good company to invest in. Not at this price, not in a million years at this price, but it's definitely one that if it drops below 100, closer to maybe $80, I will be definitely investing because I suppose they're the company that the likes of Intel will need. I mean, you can invest in Intel or Toyota. There's a host of different companies you can invest in there, but they all need this singular company. So, quite impressed with their growth over the last 2 or 3 years, and definitely one to watch.
Yeah, it's nice because it's really a company that's benefiting from the secular growth trend in further automation of society in the world, right? And one of
Yeah,
those enablers.
I mean, I just think it was really, really smart of them to get into industrial automation, particularly the robot. So I don't know if you're familiar, but Universal Robots have this cobot kind of um, the robots can work with in tandem with people, so they have a little bit of that. The user interface on their robots is so easy that you don't have to be like ABB, for example, have Robot Studio. You have to be a little bit technical in order to use that. I've done the full certification on UR robots, and honestly, I could give it to my 10-year-old. He's 11 now. I
Nice.
could give it to my 11-year-old, and he could do it. It's that easy. So I can see why that's growing and why that would be a benefit in industry. So
Yeah.
certainly impressed with him.
Yeah, user experience should never be underestimated with these kinds of products. That's really where you earn your money.
Yeah, I mean, not everybody is able to program or code or read logic. Some people
Yeah.
just want to be able to click a few buttons and let it do its thing.
Yeah. Cool. Nice, nice one. Nice one. And EMF, you also will talk about the next company, and I'm really interested in this because many people speak about the whoring 20s coming up now. That this summer will be the summer of liberty. Youth has been locked up for 1.5 year and is as horny as hell. So how was it already in Q2? Did it start already a little bit?
Yeah, so the next company I'm going to talk about is Reckitt Benckinshaw. I think I say that right. I absolutely hate saying that name. I just normally call them RB. And this is also a part of a question that one of our community members asked, Javi, asked, what do you think about them? Are they an opportunity or a value trap? So looking at the results first, they posted the results excluding IFCN China as they are selling that to Primavera Capital for about 2.2 billion. That sale is pending. So they posted all their figures without that. Revenue grew 3.7%. That reflected a volume growth of just 3%, and then they had price improvements, they call it. So basically increased the price that accounted for 3.4% of it. The flagship brands, so the likes of Dettol and Lysol, declined this year. But that's on the basis of last year where people were stocking up on all these things throughout the pandemic. If you compare that to 2019, they are still 80% more than they were in the first half of 2019. So the growth there has been incredible. We expect it to slow down, and we expect it to slow down a little bit again next quarter. But I mean, they're still way above where they were in 2019, which is a good benchmark. The health segment has stagnated a little bit compared to the year before. So this time last year, people would have stocked up on cold and flu brands at the beginning of the pandemic, stocked up their pantry, never used it because everybody got COVID and didn't get the flu and they didn't get anything else. So they got COVID tests and COVID jabs instead. So people still have that, so they're not buying as much. So that means that sales dropped this year. They expect that to pick up again maybe in the winter. And their cash flow was down 72% based on working capital being down. Operation margin dropped, This is because of cost inflation. And I know people have mentioned this already. They have said that inflation is starting to kick in and hurt our margins. But what I did like is that they said that it hasn't been passed on to the customers yet. So they fully intend to do that, and they will. They'll pass it on, but we won't see the benefits of that until maybe this time next year. So that is coming down the line. The e-commerce side is where it gets really interesting. So that has grown phenomenally over the last couple of years, and obviously the COVID has brought that on a good bit. It now represents 12% of the group sales. But what I found really, really interesting is that they're into, maybe, how would you say it, some pleasure brands, so like Durex and so on. Those sales have gone through the roof, particularly in Germany. So the Germans have been just locked up way too long, and now they're going and buying this all the time. So that has grown nearly 50 or 60%, I think, just in those kind of areas. There was a word. What do they call it? They call it something health. I can't remember. They put a phrase on it, but basically it just means foreplay or something along those lines. So they also completed the acquisition of Biofreeze, which is another treatment, kind of hot and cold treatments, which I think will do really well over the next couple of years. So overall, I honestly think it was a good quarter. Some bits are down based on this time last year, but we know lots of people loaded up on supplies. The company has come out and said that they expect quarter three to be even worse than this quarter because of that reason. So to answer Javi's question, do I think it's an opportunity or a value trap? I think there's an opportunity there, but I would wait until next quarter, because I think when the results come out and they'll be poorer, I think they'll dip again, and I think that might be a very, very good buying price. I have them priced at about a PE ratio of about 13 or 14 based on the ADR in the New York Stock Exchange. I know they're up around in the high 20s, maybe even 30s on the London Stock Exchange. So I don't know why there's quite a difference. I'm not quite sure. So I definitely would be buying them in America rather than London. But I honestly think there's a good opportunity here, considering that if you base exclude last year, and if you base where they are from 2019, they're still way ahead. They've penetrated lots of new markets, and they've held market share. Wrong choice of words, but they have broke into a few different markets and held market share in some of the key ones, such as Lysol and Dettol. So I certainly think there's a good opportunity to buy them now.
So, last week we were wrong with Kimberly Clark, with the that people will be, how you say it, not be price sensitive to toilet paper. I did a poll on that, and it's not the case. People don't want to pay 10% more for toilet paper. So the question is here, actually, what everyone probably wants to know as a listener, will Reckitt Benckiser be able to increase the price of condoms? Yeah.
So,
I mean, I don't care about the price of condoms. I would just buy them.
I mean, you're out in a night, not you, but a person is out in a nightclub, and they get the old nod, wink, wink. They go into the bathroom. They don't care if that is 20 euro, 50 euro. They're putting that money in, and they're buying them because they know they're onto a promise. So, I mean, not just in that. In general, they are huge brands that we're talking about here. They have got really, really strong brand power, particularly when you talk about hygiene and you talk about the health segment. I would I don't know why, but certainly when it comes to buying like cold and flu brands, I always prefer to buy the brand because I trust it more rather than the knockoff. Now we know that might not be the case, but it's just a psychology thing. And the same when you're buying Dettol, I just feel like it do a better job, so I will pay more for that. So
yeah,
I mean, maybe you could do a poll on that, and people can prove me wrong, but that's just me.
Cool. Hey, thank you, and also thank you for the insights. I can clearly see that you've been studying the company quite a lot. Nice one.
Yeah, I'm just waiting for a good entry point.
Yeah, I understand. Hey, then the next company is Danone, and we had Danone so often discussed on this show, and we know the whole story of Danone, the CEO gone. earlier this year or late last year. I forgot already. Dividend cut of was it 8%, I believe. Like really, I don't know even still why, because if you look at the numbers today, it's not even clear why. Because as an example, they're going to do an 800 million buyback in the remainder of this year. It's probably covering the dividends that they cut earlier this year. So that's what I don't like about this kind of stuff. I would say that their numbers in general, I found them so. Actually, you still see that they're struggling and they're trying to use some nice words to I don't know, to smooth talk or a little bit like that. But it's a bit of a mixed bag. But I didn't expect any difference here. But the main thing I was looking here at, and I think I mentioned it in one of the earlier shows, will their water sales be up? Because if restaurants are opening, that was always the reason why water was down. I wanted to see, okay, it's June was still in Q2, restaurants were open in France. I've seen it firsthand. So what is the impact here? Well, like-for-like sales growth compared to last year was around 20% up in water sales. For me, this justified and validated the whole quarter effectively. All the rest was a little bit, same old, a little bit growth, nothing fancy. I expected that. Although you could say that their dairy products up with 5% is good because, last year people were drinking more milk from home and everything. So that's quite good. But water is up. That's it. So the stock price also went up today with 6.5%. I think people are looking for this kind of stuff, right? It's a reopen play for me from this point of view. I held on to the shares. I was actually thinking this week, should I buy still some pre-earnings, because I had a lot of confidence, but I felt like, no, I'm already big in this position. First, look for the validation in the earnings, and it's here now. So it's I'm happy with it because I was really looking for this as a shareholder.
Yeah, you're bang on as usual. Water sales flew through the roof, and I still think that will increase again next quarter because we're only starting to open. We're not open fully.
Yeah.
So I can only see that going up again. But I was laughing when I look at their highlights and you see on the second line is a return to growth driven by focus on execution and delivery. Basically, they have nothing to say, so they're putting in fancy words.
Yeah,
to
it's
try and
bullshit.
to make it sound a little bit better. But I mean, looking at the numbers, it's quite positive. They had like for like sales growth in all segments and in all regions. I mean, you can't ask for much more than that. So I'm happy with that. I think this thing with the buyback program, they must be trying to drive that share price up. I think that's their main issue. I know lots of shareholders are unhappy with the price because that has just been stagnant for so long. So maybe they're just trying to tick that up and get that.
But you and I know that the 800 million buyback is 1.9% out of the outstanding shares. It's just like window dressing. To your point, the second line, return to growth. It's, you've got two executives there now. I think they just want to show, justify why the last CEO is gone. So they want to speak good about themselves. But they have no real mandate. They're like an in-between pope. So it's really waiting until the new person starts on the 15th of September. So I think by the Q3 earnings, we will learn more about the plans as well. And I'm really curious for that again. But I think we, again, also with the known, if there comes no new lockdowns around the world, I think we have left a little bit, again, the 50s zone for prices around the known. It might dip a little bit on a bad day, but I think there's more room to run now to grow.
Cool. Okay, so the last one we might touch on briefly is Pfizer. We get lots of questions about companies like Pfizer. So I kind of briefly looked at them, and come on, let's be honest. If Pfizer were not going to grow this quarter or this half year, they're never going to grow revenues. Like, vaccines are going through the roof. The revenues are up 86%. So if you're to take them without the vaccine, it's up 10%. With the vaccine, then it's up 86%. That's huge numbers. I mean, the cost of sales on the vaccine alone is nearly 7 billion, which is huge. No wonder they want to put out another booster shot, because they're making so much money off it. It's absolutely incredible. Um, the earnings obviously went up with that. R&D expenses have gone up, which is expected if they're constantly doing
Yeah.
these trials with the vaccine. Their 2021 financial guidance has again gone up based on the vaccine. So I mean, it's good. It's a good quarter from them, good results, and they're going to have a good year this year. I think they've reached an all-time high in share price, and I can only see them going one way after this, when the vaccine levels out. And look, we don't know if the vaccine is going to be recurring or if it's a once off, or we don't know, but let's just assume it's not recurring. That revenue is going to disappear.
Yeah.
So they're not going to replace that. Looking at the numbers with anything else, I think they don't even come close to the COVID vaccine. So they won't replace that, and then you can see them drop back down in price again. So I personally wouldn't be touching them at this price. If COVID vaccines become a yearly thing where you have to get them every year, then maybe they might be worth. Because
But look, if you have such a cash flow and we're in a low interest environment, make an offer on Bristol Myers, yeah, or such a company. They need to buy earnings now with this cash flow. They need to buy future earnings, and this is what AbbVie did with Allergen. After seeing the patent cliff, they just bought Allergen that was undervalued at the time. They diversified in Botox and everything, de-risked their whole company profile as an AbbVie. Dividends are sustainable. So if I think about a company in the pharma industry, Pfizer with these cash flows here, try to see if you can buy a company like Bristol Myers, if it doesn't kill your balance sheet, of course. I have not done the math, but I will be doing something like this as Pfizer. Just buy earnings for the future now. Don't go into buybacks and such, or these kinds of things. Try to buy earnings for the future.
Yeah, I'm not sure of their policy on acquisitions. I know they do like mergers. I think they've merged with different companies over time. Off the top of my head, GSK, I think they have some sort of have merged with, and something with Novartis as well. But
But those are usually licensing deals, yeah,
Yeah.
on the specific drugs or products. So I'm talking really here about an acquisition, like a pure acquisition.
Did they have a history of it? I don't know.
I think one of those actually wasn't it Pfizer that wanted to do an acquisition in the States that got declined not too long ago. Yeah,
Okay.
need to look it up.
Yeah.
Anyway, these were our 5 companies. We could have done 30 companies this show, but then we would need to do another few episodes this week. And unfortunately, we don't have time for that. Sorry for that. But yeah, massive earnings. And maybe this is the time to go to some listeners' questions.
Yeah, perfect timing. So do you want to start with Phil's one?
Yeah, let's start with Phil. So maybe for you then, hypothetically, he's asking, there's suddenly a disruptive technology in the field of your company. What do you want your company to do? Boost the R&D spendings to massively catch up, or acquire the rival company despite negative PR?
I would buy hey, we just discussed this with Pfizer above. I would buy a rival company despite negative PR, because negative PR only lasts so long, and then it goes away. Do you remember the news of the week last week?
No.
Yeah, exactly. So it was Unilever, Ben and Jerry's. So
Yeah.
I mean, negative PR, it's there, and then you acquire a company, everybody will forget about it. So I would 100% go taking over a rival company.
Yeah, me too. And then we can learn from it.
Cool. Wolf of Harcourt Street asked us, which one of the big tech earnings did you find most impressive this week?
So most impressive, probably Facebook, because there's so much negativity around Facebook. People complaining about data privacy, people complaining about not willing to be on Facebook anymore, busy timeline. But damn, they smashed earnings, really. So for me, Facebook, if you think about all the negative reputation they had over the last 3 years with Cambridge Analytical and Analytica and now still, I think this is just impressive that all the noise they keep on keeping and not just hitting numbers like big time. So for me, that is probably the most impressive for that reason. But all four of them should be in the Hall of Fame in this quarter. It's amazing.
Cool.
So then maybe last question that we'll do today, because we're trying to keep it a little bit short. We'll have the other questions that we received on the list for the next show. Here comes from Daniel, and he's asking, what was your last best non-stock related investment under €100? And what was your last worst non-stock related investment over €100?
Non-stock related. Is that in the investment world or not in the investment world?
Shoes. I don't know.
Okay. I will go non-stock related investment first. It will have to be anything to do with the kids and family just going out for dinner, or actually we bought a tent, a little 4-man tent before, just to go a little bit of wild camping. No bells and whistles, just I think it was about 95 euro. Probably the best investment. We got so much fun out of it. We were camping out the back garden to test it out first, and then you go camping for real. And I think anything like that is a great investment, especially when it's got to do with family. My worst non-stock related investment was buying my brand new car back in the boom times. I think it was about 21. I was earning lots more money than I had sense at the time. And I bought a brand new Range Rover. Well, not a Range Rover, Land Rover, by the same company. Cost me a shit ton of money, and I regret it ever since, because I was paying it for years. Even after I got rid of it, I was paying it for a very, very long time. So those were my best and worst investments.
So mine was the best non-stock related investment under €100 was a book about General Electric, Lights Out. I bought it like last week or 2 weeks ago for €8 on Kindle. I really love it. I'm halfway. I can really recommend it. And the worst non-stock related investment over €100, that was, I bought my first house or first flat in the Netherlands in December 2007, January 2008, just before the whole market collapsed. And it was not a place I wanted to live for another decade. So yeah, it was talking about timing. That was not the right timing. I definitely made a loss on that.
I bought this house I'm in now. I bought that we moved in September 2008. So we would have had the keys about a month before.
Yeah.
So August. And then I'd say we just got the keys and the market just fell out. So that was fun.
Yeah, exactly. Cool. So then let's go to the next section, and the last section. That's a stock pick of the week. And here I would like to thank a person that I was chatting a bit with on Twitter via the direct messages, and his name is Martijn Hoek, because he shared his portfolio with me. And one of the companies that I spotted there was Unum Group. And this is an insurance company. Most people would know it from employee benefits, because I guess it does a lot of deals with companies and such to insure, to give, let's say, certain policies to their employees, right, at a nice discount. So it mainly is earning its money from the US, but also it's in the UK and Poland active. But the majority really comes from the United States. But if you think about the kind of segments they operate in, it's disability. That's in the US, for instance, they earn 40% of their premiums from this one, disability insurance, but also life and accidental death insurance, 30%, some individual disability, voluntary benefits, and dental and vision. So, these are typical packages you often can get as at your employer as such, right? So I really like this company. I really like what I saw. It has already quite some history, but it was totally new for me. But what I also liked about it, it has a dividend yield of 4%, a current payout of 26%, but you need to count some one-offs here, right? Their last dividend hike was 5.3%, so it's also nice around the 6%, and they have a dividend growth streak of 13 years. So, this went through my stock screener. I didn't do a deep analysis, but I wanted to call it out as a stock pick because it's so nice to discover new companies which already have quite some history. They're under discussed probably in the bubble that I am getting my information from.
Yep.
So yeah, this was one of those positive discoveries I had after chatting with Martin Hoek. So I think it's worth for others also to look into. I think.
Nice. I'm vaguely familiar with the company, but that was a nice run through. Okay, so we've come to the end of the show. I know earnings is still ongoing. There's probably earnings as we speak, and there'll be more tomorrow. So we'll probably have another run through next week on some more companies. As always, if there's companies that the listeners want us to talk about, please let us know beforehand, and we will happily talk about them. But thanks very much to European DJI again. Your knowledge is always welcome, and
Likewise.
And thank you to the community, and we will see you all next week.